Index funds, mutual funds, hedge funds, ETFs. You've heard these words thrown around constantly in finance videos, on Reddit threads, on TikTok, probably from that one friend who discovered investing 6 months ago and won't stop talking about it. And every time someone explains them, they either make it way too complicated or they skip over the details that actually matter. So today, we're doing it properly. We're going to cover all four: what they actually are, how they work, what they cost you, and most importantly, which one is actually right for you depending on where you are in your financial life. Quick disclaimer before we start. Nothing in this video is financial advice. This is purely education. Always do your own research or speak with a qualified financial advisor before making investment decisions. All right, let's get into it. Before we compare all four types, we need to make sure we understand what a fund actually is, because the concept is the same foundation underneath all of them. Here's a simple way to think about it. Imagine you and a group of friends want to rent a vacation house for a week. The house is amazing. Pool, ocean views, the whole thing. But none of you can afford it alone. So you each put in a portion of the cost. Together, you can afford it. You split the experience, and you split whatever comes with it, the good weekends and the rough ones if something goes wrong. That's essentially a fund. A group of investors pool their money together, and that pooled money gets invested into a wide range of assets: stocks, bonds, real estate, and more. Instead of trying to manage dozens of individual investments yourself, the fund handles it, and you share in the overall results. The risk is spread, the cost is shared, and the barrier to entry is much lower. Now, the four types of funds we're talking about today all work on this basic principle, but how they're structured, how they're managed, what they cost you, and who they're actually designed for, those things are completely different. Let's start from the top. Index funds are probably the most talked about investment vehicle on social media right now. You've seen the posts, just put your money in an index fund and let it grow. And while that's not wrong, it's worth actually understanding what that means. An index fund doesn't try to outsmart the market. It doesn't have a team of analysts picking stocks. Instead, it simply follows or tracks a pre-existing list of companies called an index. Think of an index as a leaderboard representing a specific part of the market. The S&P 500, for example, is an index that tracks 500 of the largest, most established companies in the United States. Companies like Apple, Microsoft, Amazon, and Johnson & Johnson. When people say the market went up today, they're usually referring to something like the S&P 500. There's also the Nasdaq, which leans heavily into tech, and the Dow Jones Industrial Average, which tracks 30 large blue-chip companies across different industries. An index fund simply buys what's on that list in proportion to each company's size. No guessing, no strategy, just follow the index. Because there's no active management involved, no fund manager making calls, the fees are extremely low. We're talking expense ratios anywhere from 0.02% to around 0.20% per year. To put that in real terms, on a $10,000 investment, you might pay between $2 and $20 per year in fees. That's it. One thing to know about how index funds trade: unlike stocks, you can't buy into an index fund at any moment during the day and lock in that price. Index funds are priced once per day after the market closes, usually around 4 p.m. Eastern Time. That price is called the net asset value, or NAV. Whether you placed your order at 9 a.m. or 3 p.m., you get the same end-of-day price. For long-term investors, this really doesn't matter at all, but it's worth understanding so you're not caught off guard. Major providers include Vanguard, Fidelity, and BlackRock through its I lineup. And the reason index funds have become so popular, even Warren Buffett recommends them for most everyday investors, is simple. They're low cost, low effort, and historically they perform very well over the long term. Because it turns out, consistently beating the market is incredibly difficult, even for the professionals.
Now let's talk about mutual funds. At first glance, they look almost identical to index funds. Pooled money, diversified assets, professional oversight. But the key difference is in how they're managed. Most mutual funds are actively managed. That means there's a real human being or an entire team whose job is to study the market, pick investments, and try to beat a benchmark like the S&P 500. The goal is to outperform the index by making smarter decisions at the right time. That sounds appealing in theory, but here's the catch. Active management costs money. Mutual fund expense ratios typically run anywhere from 0.5% to 1.5% per year and sometimes higher. Compared to an index fund charging you 0.03%, that difference compounds significantly over time. And the uncomfortable truth that the data keeps confirming is that most actively managed funds don't consistently beat their benchmark over the long run. Studies over the past decade have shown that the majority of active fund managers underperform passive index funds after fees are factored in. That said, mutual funds aren't useless. Some investors prefer them because they want exposure to a specific sector, country, or asset class that isn't easily available through a standard index fund. Others like knowing there's a dedicated manager watching their investment and adjusting the strategy when conditions change. And mutual funds also allow you to invest in fractional amounts, meaning you can put in a precise dollar figure rather than buying whole shares, which makes automatic investing easier to set up. Just like index funds, mutual fund trades are executed once per day at the closing NAV price. Major providers include Vanguard, Fidelity, JP Morgan, and T. Rowe Price. If you're looking at a mutual fund, always check the expense ratio and confirm whether it's actively or passively managed before you commit. Hedge funds are a completely different category, and I want to be upfront about this. If you're an everyday investor watching this video, hedge funds almost certainly aren't for you. And that's not an insult, it's literally how they're designed. A hedge fund is a private investment fund that pools money from wealthy individuals and large institutions, pension funds, endowments, that kind of thing, and invests using highly complex, aggressive strategies. We're talking short selling, which is essentially betting that a stock will go down in value. We're talking leverage, which means borrowing money to invest more than you actually have, derivatives, options, currency plays, things that most investors never need to touch. The strategies can produce massive returns. They can also produce massive losses. That's why hedge funds are restricted to what's called accredited investors, people with a net worth over $1 million or a high annual income, because regulators have determined that these people can afford to absorb the risk. And the fees reflect the complexity. Hedge funds are famous for something called the 2 and 20 model. That's a 2% annual management fee charged on your total investment, plus 20% of any profits the fund generates. To put that in perspective, if you invested $1 million and the fund returned 10%, you'd owe $20,000 in management fees plus $20,000 in profit sharing. That's $40,000 out of a $100,000 gain. The fund has to perform exceptionally well to make that math work in your favor. For most people, hedge funds are more of a fascinating thing to know about than something to actually invest in.
Finally, ETFs, exchange-traded funds. And these are genuinely interesting because they work as a kind of hybrid between an index fund and an individual stock. Like an index fund, an ETF typically tracks a specific index and gives you diversification across hundreds of companies through a single purchase. But unlike an index fund, an ETF trades on a stock exchange throughout the entire trading day. You can buy it at 10:15 a.m. and sell it at 2:30 p.m. if you want. The price moves in real time based on market conditions, just like any individual stock. That intraday flexibility opens up options that index fund investors don't have. You can set limit orders, meaning you specify a maximum price you're willing to pay. You can set stop orders to protect yourself if the price drops. If you're a more active investor who cares about timing your entries and exits, ETFs give you that control. In terms of fees, ETFs are very competitive. Expense ratios typically range from 0.03% on the low end to around 0.75%, depending on the type of ETF. Most passively managed ETFs that track major indexes are right at the bottom of that range. There's also a tax efficiency advantage worth mentioning. Because of the way ETF shares are bought and sold between investors on the open market, rather than directly through the fund company, the fund itself rarely needs to sell its underlying assets, which means fewer taxable capital gains events for you as an investor. Compared to actively managed mutual funds that frequently buy and sell holdings and can trigger capital gains even in down years, this is a meaningful benefit. One practical note, most ETFs require you to buy whole shares rather than fractional dollar amounts, though this is changing on some platforms. Vanguard now allows automatic investments into ETFs, and many brokerages offer ETFs with no commission fees, meaning your buy and sell orders cost you nothing beyond the expense ratio. Well-known ETFs include the SPDR S&P 500 ETF, ticker SPY, the Invesco QQQ tracking the Nasdaq, and Vanguard's Total Stock Market ETF. Let's pull it all together. If you're an everyday investor focused on long-term wealth building, index funds and ETFs are almost always going to be your best starting point. They're low-cost, broadly diversified, and they don't require you to constantly monitor or adjust anything. The data consistently shows that most people, including most professionals, are better off owning the whole market cheaply than trying to pick winners expensively. Between ETFs and index funds specifically, if you value trading flexibility during market hours or want slightly better tax efficiency, go with an ETF. If you prefer simplicity, want to invest a fixed dollar amount automatically each month without thinking about share prices, or are just starting out, an index mutual fund may actually be the easier choice. Mutual funds with active management make the most sense if you have a specific investment thesis, a particular sector, emerging market, or asset class, and you genuinely believe in the strategy of the fund manager you're choosing. Just go in with open eyes about the fees and the historical reality that most active funds lag their benchmarks over time. Hedge funds are for accredited investors with high net worth, high risk tolerance, and access to opportunities that simply aren't available on standard brokerage platforms. If that's you, great. If it's not you yet, that's fine too. That's the full breakdown: ETFs, index funds, mutual funds, and hedge funds. Hopefully, this makes those words feel a lot less intimidating the next time you hear them, because understanding what you're investing in isn't optional. It's the first step to actually making your money work for you. If this helped you, hit the like button. It genuinely makes a difference for this channel. Subscribe if you want more finance content explained like this, and drop any questions in the comments below. I read them. See you in the next one.